What is hedging? Although it may sound like the term hedging refers to something that is done by your gardening obsessed neighbor, when it comes to investing, hedging is a useful practice that every investor should be aware of. In the stock market, hedging is a way to get portfolio protection, and protection is often just as important as portfolio appreciation. Hedging is often discussed more broadly than it is explained. However, it is not an esoteric term. Even if you are a beginning investor, it can be beneficial to learn what hedging is and how it works. The best way to understand hedging is to think of it as a form of insurance. When people decide to hedge, they are insuring themselves against a negative event's impact on their finances. This doesn't prevent all negative events from happening. However, if a negative event does happen and you're properly hedged, the impact of the event is reduced. In practice, hedging occurs almost everywhere. For example, if you buy a homeowner's insurance policy, you are hedging yourself against fires, break-ins, or other unforeseen disasters. Portfolio managers, individual investors, and corporations use hedging techniques to reduce their exposure to various risks in financial markets. However, hedging is not as simple as paying an insurance company a fee every year for coverage. Hedging against investment risks means strategically using financial instruments or market strategies to offset the risks of any adverse price movements. Put another way, investors hedge one investment by making a trade in another. Technically, to hedge requires that you make offsetting trades in securities with negative correlations. Of course, you still have to pay for this type of insurance in one form or another. For instance, if you are long shares of, let's say, XYZ Corporation, you can buy a put option to protect your investment from large downside moves. However, to purchase an option, you have to pay the premium or its premium. If the investment you are hedging against makes money, you have also usually reduced your potential profit. However, if the investment loses money and your hedge was successful, you will have reduced your loss. Hedging techniques generally involve the use of financial instruments known as derivatives. Two of the most common derivatives are options and futures. With derivatives, you can develop trading strategies where a loss in one investment is offset by the gain in a derivative. Suppose you own shares of, let's say, Corey's Tequila Corporation, the ticker CTC. Although you believe in the company for the long run, you're worried about some short-term losses in the tequila industry. To protect yourself from a fall in the CTC stock, you can buy a put option on the company, which gives you the right to sell CTC at a specific price. This is also known as the strike price. This strategy is known as a married put. If your stock price tumbles below the strike price, these losses will be offset by the gains in the put option. Another classic hedging example involves a company that depends on a certain commodity. So let's suppose that Corey's Tequila Corporation is worried about the volatility in the price of agave. This is the plant that's used to make tequila, even though if I can't pronounce it. The company would be in deep trouble if the price of agave were to skyrocket, because this would severely impact the company's profits. To protect against the uncertainty of agave prices, CTC can enter into a futures contract. A futures contract is a type of hedging instrument that allows the company to buy agave at a specific price at a set date in the future. Now that Corey's Tequila Corporation or company can budget without worrying about the fluctuating price of agave. If agave skyrockets above the price specified by the futures contract, this hedging strategy will have paid off because CTC or Corey's Tequila Company will have saved money by paying the lower price. However, if the price goes down lower than that, CTC is still obligated to pay the price in the contract, and therefore they would have better off not hedging against the risk. Because there are so many different types of options and future contracts, as an investor can hedge against nearly anything, including stocks, commodities, interest rates, or currencies. Now, let's talk about some of the disadvantages of hedging. Every hedging strategy has a cost associated with it. So before you decide to use hedging, you should ask yourself if the potential benefits justify the expense. Remember, the goal of hedging isn't to make money, it's to protect yourself from losses or your company from losses. The cost of the hedge, whether it is the cost of an option or lost profits from being on the wrong side of a futures contract, can't be avoided. While it's tempting to compare hedging to insurance, insurance is far more precise. With insurance, you are completely compensated for your loss. Hedging a portfolio isn't a perfect science. Things can easily go wrong, although risk managers are always aiming for the perfect hedge. It is very difficult to achieve in practice. Now, with that being said, I just gave you a brief overview of hedging, but I think it's very important that everybody learns just the basic fundamentals of what's going on Wall Street and take those lessons down to Main Street. Now, with that being said, let's move on to the next video.